to make sure that the financial sector has the liquidity it needs, but at the same time, we're going to keep interest rates relatively high until we see signs that inflation is under control. So I think that some of the whipsawing that you're seeing in the market might even get worse as Jay Powell turns out, comments on early cuts are not likely to occur.
You know, it's funny, before we started with you, Jess and I were talking about the work function, the world interest rate probability function on the terminal, like over the last week or so. Like, it's just been wacky. Having said that, there has been so much volatility in the Treasury trade. Does that also say to you that, or what we've seen so far, is it likely to continue, that we can see these extreme swings, which is just a reminder that when the Fed meets next week, they're going to look at exactly what's right in front of them, maybe not necessarily what happened a week ago?
Yeah, well, they are going to take into account what happened this week. Obviously, the financial instability. They're still going to talk about the February inflation data that we got on Tuesday. So we're going to definitely be looking backward and also a little bit looking forward into the financial sector angst that are going on. I think when we're talking about things like the WRP function and looking at where two-year yields are, there were a lot of people who were still short front-end interest rates, right? There were still a lot of people who I talked to just a week ago that were saying the Fed's going to keep having to keep hike. We're going to see the Fed funds rate at 5 3/4 or 6%. I even thought there was a non-zero chance of that. At this point, I think that has to be taken off the table, and the market's just completely repriced. Now, I think the market went from one extreme, being very bearish, to being almost overly bullish, and in part because it seems like positioning was all very one way. People were in yield curve flatteners and also short the front end, and that's probably taken down the other way, where a lot of people are now probably long or at least flat the front end of the market. So I think at some point we'll settle down here and get a little bit of a pullback, but not while we're in the midst of large international banks having to be bailed out by regulators.
I want to go back to where you were talking about this dramatic steepening of the yield curve. How much of this was really driven by short covering?
Yeah, we think quite a lot of it. Unfortunately, some of the data is not overly available, and you would have it worse because there was an issue with some of the data that was released out of the Commitment of Traders report from the CFTC. So we don't even know the futures positioning up to date. They only have that data through February 28th. So we don't even know what that was like last week. But it definitely feels, and just speaking with a number of investors and our clients, and as well as trading desks, it does seem a lot of this was position squaring, people getting flat, and people just taking a lot less risk and reducing their exposure. The flattening trade, getting to negative 100 basis points on the 210s, for example, that was kind of, I think, an important psychological target. And once we got there, some people were very ready to pull the trigger because they were also very positive in those trades. They had made a lot of money over the first couple of months of the year being in flattening positions. So the steepening is not a huge surprise.
Ira, do you think in terms of a 5% on the 2-year, we're done with that in this cycle?
I'm sorry, my earpiece came out. Can you ask that once again?
Absolutely. A 2-year note at 5%, right? It was above that last week. Are we kind of done with that level in this cycle?
Yeah, I think we might be. 480 was the level that we had tagged as kind of the peak in yield, and that gets you a Fed funds rate of around 5 1/4%, and then the Fed on hold for the better part of a year, and then cutting interest rates. So I think getting back up to 5, that's an extreme case. I think you would need to get financial stability and kind of this fear that the financial sector isn't broken out of the way very soon in order to get a resumption of the idea that the Fed's going to hike above 5 1/4, 5.5%. So I do think that we're not likely to see that. Now, can we pull back to 4 1/4, 4.5 again? Yeah, I think that's completely possible. And that's an environment, like I just mentioned, where the Fed hikes to 5 1/4%, and then stays there for the rest of the year. And I think in that environment, you get to that 4.5 kind of Fed funds rate, but not much higher than that.
Carol earlier brought up the balance sheet. What do you think this means, Ira, as far as if you have the Fed potentially, if they do pause rates, what does that mean in the background if they still have that issue with the balance sheet? Is that still essentially tightening?
Yeah, I think it is. I think they'll try to continue to reduce the size of the balance sheet just because they think that it's much larger than it needs to be. It's very large as a share of the economy. Typically, and I was just looking at this with my associate Will Hoffman today, that the balance sheet is much larger as a share of the economy than it usually is. Usually, the Fed owns around 17% of the Treasury market. That's on average, and now they're upwards of 21%. So trying to shrink their balance sheet back to quote unquote normal conditions is, I still think, a policy goal. And I think it's much more likely that they pause, continue to run off the balance sheet at least for a little while, and then reassess if there continues to be these financial challenges. Now that doesn't mean that the Federal Reserve won't offer funding to financial institutions as the lender of last resort. They absolutely will. But at the same time, they think that they don't necessarily need to own treasuries. And, given the demand of treasuries the last couple of weeks, there's not going to be any problem with the Treasury Department issuing more bonds over the next couple of weeks at least.
We are definitely living in fascinating times. Ira, thank you so much. Ira Jersey, Chief U.S. Interest Rate Strategist here at Bloomberg Intelligence. Really always a must-read when it comes to what's going on in the rates market. Joining us from our BI Bureau in Princeton, New Jersey. Fascinating.
It really is, and it makes me think of, especially you bringing up that great point about the balance sheet, reminiscent of what we saw in fall of 2018, Carol, right before we saw that big sell-off that year.
No, you think about the Fed, right, and what it's dealing with, and rolling off those assets in the balance sheet. That is certainly impacting, tightness, certainly, right, when it comes to the environment. All right, everybody, let's get back to world and national news. Off to D.C. and Nancy Ryan. Hey, Nancy.
Thanks, Carol. Moscow says it will try to retrieve the wreckage of a U.S. surveillance drone that crashed into the Black Sea yesterday after a collision with a Russian fighter jet. Meanwhile, U.S. Defense Secretary Lloyd Austin says he's spoken with his Russian counterpart and told him the incident will not deter the U.S. continuing those flights.
As I've said repeatedly, it's important that great powers be models of transparency and communication. And the United States will continue to fly and to operate wherever international law allows. And it is incumbent upon Russia to operate its military aircraft in a safe and professional manner.
Austin spoke after holding a virtual meeting of the Ukraine Defense Contact Group. He says Russia is running out of capability and running out of friends after taking down that drone. Some lawmakers in Congress are calling for a return to tighter banking regulations after the recent failures of Silicon Valley Bank and Signature Bank. Federal regulators had to step in and ensure depositors would have access to their money. But lawmakers like Senator Elizabeth Warren say a rollback of some Dodd-Frank regulations back in 2018 led to the bank's collapse. She says it's time to go back and fix the threat. Longtime Green Bay Packers quarterback Aaron Rodgers says his intention now is to play next year for the New York Jets.
Because I still have that fire, and I want to play, and I would like to play in New York. It's just a matter of, getting that done at this point.
His comments came during an appearance on the Pat McAfee Show on YouTube and Sirius XM. He says the Packers are still working out what their compensation would be for the trade. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
This is Sam Keane. I'm Jonathan Ferro.
And I'm Lisa Abramowitz.
Join us tomorrow morning for Bloomberg Surveillance.
The ECB meets within a continuing banking crisis. We speak with Jeffrey Yu of BNY Mellon.
And an eye toward the painful decision next week for the Federal Reserve with Neil Dutta of Renaissance Macro.
Bloomberg Surveillance starting at 7 a.m. on Bloomberg 1130, Bloomberg Television, and the Bloomberg Business app.
Or listen on demand on Apple, Spotify, or wherever you get your podcasts.
Interactive Brokers charges margin loan rates from 5.08% to 6.08%. Their clients can also earn extra income by lending their fully paid shares of stock. Join Interactive Brokers clients from 200-plus countries and territories to invest in stocks, options, futures, funds, and bonds globally. Minimize your costs to maximize your returns. Rates subject to change. Learn more at ibkr.com/compare.
Dear Calvary Hospital, my father, Curtis Moore, is my hero. Now 96 years old, he has led an exceptional life of self-sacrifice. A Market Point Marine, a New York City detective, and a family man who cared for his children and grandchildren his entire life. So when other hospitals could no longer relieve his suffering or our family's emotional pain, we brought in Calvary's miraculous team of home hospice experts. Thanks to Calvary's doctors, nurses, and social workers, Dad was able to resume the quality of life he wanted and deserved, and I was able to become his daughter again, surrounded by the love of his entire family. Thank you, Calvary. Phyllis Robinson.
This is Frank Calamari, president of Calvary Hospital. With Calvary at Home, experience our unique Calvary care right in your own home. Call us today at 718-518-2465.
25 years ago, NJIT graduate Dick Sweeney co-founded Keurig Green Mountain, a company whose incredible innovations changed the way the world brews a cup of coffee. Today, he lectures widely on business leadership and is a strong advocate for NJIT's work to combine business education with the power of STEM.
NJIT is definitely fostering the innovative thinking for budding entrepreneurs simply because that's the world we live in. NJIT is producing students that have been trained, educated, and given the business acumen to be a contributor to a company. The distinct mission is to develop great STEM scholars. The attributes I've always looked for in team members are heart, smarts, guts, and luck. So we want people with passion, intelligence, courage, and never discount luck. The student coming out of NJIT has experienced all of that.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
Bloomberg Radio, on demand and in your podcast feed. On the latest Sound On podcast, Energy Secretary Jennifer Granholm on the administration's clean energy challenges since President Biden approved the Willow oil drilling project in Alaska.
It's really important that we recognize that we are going through a managed transition. So we have to be, and this is what the president has called upon, we've called upon, we have to be producing right now so that we don't end up seeing these prices jack up as a result of the volatility of the war, for example. And at the same time, we have to be accelerating toward clean. And in this case, really important to be accelerating toward net negative carbon pollution. For example, removing carbon dioxide from the atmosphere, which is part of what was invested in through that bipartisan infrastructure law last year.
To put a finer point on it, Secretary, does this Willow project make it more challenging or delay the goal of reaching net neutrality by 2050?
Well, I think it is very clear that we have to accelerate these carbon negative technologies as well. And while, we all have to recognize that because of this transition and because of the volatility associated with pulling, whether it's Russian barrels of oil or Russian natural gas off the market, that we still have to allow people to get from place to place affordably and turn on the lights. So this is why the balance is really important, but it's also why we have now invested the greatest amount that the United States ever, in fact, one of the largest investments in the world in these clean technologies. And that's what we're doing at the Department of Energy, is deploy all these clean technologies so that we can have a balanced transition.
Hear the full conversation on the latest edition of the Bloomberg Sound On podcast. Subscribe on Apple, Spotify, and anywhere else you get your podcasts. Plus, listen anytime on the Bloomberg Business app and Bloomberg.com. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television and the Bloomberg Business app. This is a Bloomberg Business Flash.
And we check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. 4:40 past the hour now. A lot of drama on Wall Street today, but after all that drama, stocks managed to finish mixed. The Swiss National Bank to the rescue after Credit Suisse shares plunged earlier. Its top investor said it wouldn't buy more shares. That triggered the sell-off, and it got pretty bad for a while. Even some signs of chaos in the swaps market. But Bob Michael, CIO and global head of fixed income at JP Morgan Asset Management, says Credit Suisse shows the lagging impact of central bank tightening is really catching up with us, and he says watch for more.
If you think about where we were a year ago, the Fed was just starting its rate hiking cycle. So over the next couple quarters, you're going to get those long and variable cumulative and lagged impacts hitting the market further. So I think this is the tip of the iceberg. I think there's a lot more consolidation, a lot more pain yet to come.
And all this has some speculating that we could even be on the cusp of a recession, and of course that is all triggering hope that the Fed might lay off the interest rate hikes. The Dow closing down 281 points, the S&P 500 down 27, the NASDAQ up 6, as I mentioned. Yield on the 10-year right now, 3.46%. We were at 3.39 earlier today. NYMEX crude, it's down 4.3%. Spot gold up about 0.7%. Adobe shares higher. Adobe boosting its earnings forecast for the year, and that signals demand for creative software remains resilient. And that is a Bloomberg Business Flash.
All right, Denise, thank you so much. Carol Master along with Jess Menton live here in our Bloomberg Interactive Brokers studio, streaming on Bloomberg Originals and, of course, on YouTube. Want to get to our next guest. You know the backdrop, global markets on edge, fresh turmoil at Credit Suisse, just a few days after the collapse of some American regional banks spurred a frantic rush for cover. You've got the Fed working with the Treasury to review U.S. financial sector's exposure to Credit Suisse. And then we've seen a real repricing when it comes to expectations on the Fed. So, jam-packed day. Great to have back with us Peter Atwater, adjunct professor of economics at William & Mary, former Wall Streeter, someone who really so smartly connects Wall Street and Main Street and Washington. He is the person who coined the term K-shaped economy, and he's a financial historian, and he is joining us via Zoom in Pennsylvania. Peter, good to have you here with Jess and myself. I got to first ask you, if you were still on Wall Street, would you be hunkering down and moving assets into safe havens because you thought, okay, there's more to this crisis than we've seen so far? And I can use crisis, I think, actually. It's 3 banks that have gone down. Credit Suisse has had problems for a long time, so I've got to be careful in what I say.
Yeah, I think we're in the midst of a panic, and so I think that's a good term because it describes the environment in terms, at least in terms of confidence in the way people feel. You know, I think everybody is hunkering down. It's a natural response to our low confidence. So I expect that every firm on Wall Street, if not regional banks and global banks right now, are looking at all their risk positions. It's a natural, impulsive, emotional response to what we've seen.
Peter, you mentioned the environment.